B of A's sell-side indicator shows equity allocations slid to 52.7% in March. That's a lower reading than in both late 2008 and at the March 2009 lows. But my next guest says opportunities appear when pessimism is rampant. So joining me now are Andrew Sliman, Senior Portfolio Manager over at Morgan Stanley Investment Management. Also, Abhay Deshpande, Chief Investment Officer at Centerstone Investors. Gentlemen, thank you both for being here right now. It just pained me to say that. I don't even believe it. But Andrew, if it really is true that there are sentiment indicators showing it worse than the financial crisis, it sure doesn't feel that way.
Well, I mean, look, you got to remember the market is back to where it was 2 years ago. We've gone nowhere for 2 years, and sentiment always follows price, and therefore people are very, very negative. And if I had listed, hey, here's what's going to happen this year at the beginning of the year, Dom, and then said, do you think the market would be up 7% for the first quarter? You said, no way, you're crazy. So I think that's not necessarily a reason to be bullish, but I think it explains why the market is not going down in the face of all this negative news.
Abhay, the reason why it catches a lot of folks' attention is because we do have our fair share of negative catalysts in the market right now. I think global banking crisis, possibly an economic system that may be teetering on the verge of some bad things, a Federal Reserve and central bank policy that still has to fight inflation. Why be optimistic now?
Well, I think you raised 3 out of possibly 1,000 variables that exist right now. And I mean, in my view, I just don't know that I certainly don't have the ability to create some sort of grand unified view of the entire world. So that's why we at Centerstone, we're stock people. We invest security by security, and that's what drives my optimism. Over the last, as Andrew mentioned, I mean, stocks, generally speaking, have not done much over the last couple of years. But once you look outside the United States, for instance, in Europe, they have not done much for like 10 years. There's a lot that's been discounted, and to the point now you're getting dividend yields outside. In Europe, for instance, are above the Treasury rates. Very different than here. You have earnings, plenty of earnings kind of latency, and above all of that, or just floating above all those kind of potential upsides, you have the euro that's very, very depressed versus the dollar, has been rebounding recently. And I think very importantly, just from a macro point of view, the dollar is not spiking higher during what looks to be some stress. In fact, I mean, on a day like this, Deutsche Bank is doing better than JP Morgan. That's kind of odd, and it explains why the price of gold is going higher, which we also own some gold. So if I just put everything together, one thing I've learned over the years is like I have, and very few people have proven to me that they have the ability to really have an accurate forecast about the future. We remain stock driven as a result, and we're finding plenty to do.